Hey, welcome to another edition of the Tuesday Loan Lowdown, where I typically will break down a loan product. But in this video, I'm actually going to talk about a strategy that is overlooked big time in this market right now. And let me just set this up. I have the opinion that because we're in a higher rate, low inventory market, and I'm still seeing multiple offers even with this higher rate. And when you see multiple offers, what does that do? That drives the price up. So we're still seeing that. And because of that, what I'm going to share with you is applicable. Now, if you feel that this is a housing bubble and this is all going to crash, well, then this video is probably not for you. But if you look at the history of home appreciation and look at the resiliency of the housing market, look at how we've bounced back from the worst meltdown we could imagine in 2008 to where we are today, well, there's opportunity. And what I want to share with you is a concept called the cost of waiting. And nobody talks about that, right? And that's the second half of the challenge here. So let me get myself out of the way and I'm going to show you what I'm talking about here. So what I did is I want to share with you a cost of waiting analysis for a purchase price of $550,000. I'm using Bucks County as an example here. And this tool is amazing. It pulls in data, which is critical. Now, don't worry about all these numbers here. I'm not trying to confuse you. I'm going to go over the highlights here. But if you have a new loan today and you're going to buy and you get your house under agreement for $550,000, you put 20% down. Today's rate, let's assume it's 7.75%. All these numbers are just examples. They aren't quotes, but this is just a scenario that I created to show what a cost of waiting scenario would look like here. Now, what's most important to people is monthly payment. Again, this is principal and interest. We're not talking about taxes and insurance right now. But if your principal and interest is $31.52 today, and you decide to wait 6 months, right? And even if rates come down a quarter, right, your payment's a little lower. So rightfully so, yeah. Hey, if you wait and rates come down, you're going to have a lower payment. Likewise, if you wait a year and rates come back down to 6 3/4, and in 2 years they're 5 3/4, and maybe 3 years they're 5 1/2, again, because this is what people feel could possibly happen, and that's what they're waiting for. Well, if you look at the principal and interest, yeah, $31.52, you're down to $29.97 or $27.83 or $27.87. These payments certainly seem better than what you could get today. And if you base your decision only on this and you stop right there, you're missing the other half of the story. Now, the other half of the story is, what is the cost of waiting? So, as I said, if you wait 6 months, well, your payment's going to be $36 a month cheaper. If you wait a year, it's going to be $155 cheaper. 2 years, $370. 3 years, $365. Okay? And your annual loss in cash flow is actually a gain, right? These are all gains in cash flow. So if you stop here and you only want to base your decision off of rates, and you're only looking at this, then you made the right decision, right? You're going to have a lower payment. If you look at the big picture, though, what most people don't account for is the loss in property appreciation. So waiting 6 months, that property could appreciate $7,100. Plus, you've paid down $1,894 of your loan. So if you got a loan 6 months ago and you've been paying on it and you have some appreciation, waiting could cost you $9,000. Waiting a year, well, now you can see the numbers get bigger. It could be $31,000 in appreciation, $54,000 2 years, and $76,000 3 years. These are big numbers. Now, where are we getting these numbers? If I scroll back up to the chart here, right, waiting 6 months in a market where there's more demand than there is inventory could push prices up 1.3% just by waiting. Well, if you wait a year and you get another 4% in appreciation, all right, that's a 5% total that you've missed from today to waiting a year. And let's say it appreciates another 3% by waiting 2 years. You're now at 8.37% gain in that property value since you waited instead of buying today. Waiting 3 years, if you had another 3% or so, you would have had around 11.57% in appreciation. And that's what's reflected down here. And that's what a lot of people aren't looking at. So if you're under the assumption, like we are, that rates are going to come down at some point, and you buy today, you certainly can have your cake and eat it too. Because if rates do come down in 1, 2, or 3 years, you're just going to refinance anyway. So not only are you going to have the appreciation, but you are going to end up getting the lower payment. And so what we do is we run a cost of waiting analysis on all of the clients that we have pre-approved that are coming back saying, hey, I think I want to wait a year or 2 or 3. Now, look, there are valid reasons for people waiting. Some people need to fix their credit. Some people need to save more money. Some people have job opportunities that are going to be changing. Yeah, there's all kind of valid reasons. But if you do qualify for a mortgage today and you can buy and you can get a deal that makes sense to you, and we get appreciation over the next 3 years because of the low inventory and higher demand, which would continue to drive prices up, well, that could be a winning situation for you. So if you have any questions, direct message me anytime. If you want to talk about this, if you want me to run a cost of waiting analysis for you on a specific property, we can certainly do that as well. And I hope this was helpful, and I hope you have a great day.